Dude, this is awesome.
You
We
like that?
actually we actually have theme music. The South Florida Mortgage Report has theme music, and it's Calculation Man.
It's going to be a chart-topping smash.
Wow, this is amazing. Awesome. See, we're really, really legit. So this is the South Florida Mortgage Report. Welcome. It's Billy May, your hat dude wearing mortgage guy. Always joined with Capital Partners Mortgage President Craig A. Garcia, who's introduced some awesome theme music for today. It's Calculation Man. Hit
Hope you
like,
enjoy it.
hit subscribe, tell your friends.
There you go.
All right, Craig. We got it. It's a season of giving, right? This is the holiday season of giving. As always, we're going to talk about a few different things. We're going to start with mortgage rates. I'm going to talk about that, but it's the gift of giving. What else? Who wouldn't want the gift of equity, right, Craig? Gift of equity.
That's right. Sometimes you are lucky enough to receive a gift that's not wrapped. It's a home.
That's right.
And so we thought we would go a little deep on a topic that is uh, not every day something that you see, but it does happen, and it is a fantastic thing, and which is when somebody gives a gift of equity in a
Yeah.
property to a loved one.
Yeah. So we're going to do a deep dive on that today. Gift of equity. What is it? How does it work? Etc. Going to come over some numbers for you too. Speaking of numbers, mortgage rates trending downwards. So we're kind of in that low sixes, six and a quarter, 6.5 range, and that's Fannie Mae conventional now. Now remember, if you get a VA or FHA loan, you could possibly get lower sixes, even a high fives. But the rate's been trending downwards. We're kind of at our lowest point since late October, I believe, and really it was because of those CPI numbers that came out yesterday, Craig. And what exactly are CPI numbers? What does that mean for the average consumer?
So CPI is the Consumer Price Index, and so this is it's the price, it's the kind of the relative price of a basket of goods that consumers pay for, and this is there's two big economic reports every month that kind of garner the most attention from the financial markets. On the job side is the non-farms payroll report, which we talked about last week. And then on the inflation side, it's CPI has been the big daddy inflation report of the month. And we got good news. So
Yeah.
the inflation report came in. It was a lot less than anticipated, which
Yeah.
we had one of the Fed people came out today and was talking about the fact that they think that the number was skewed a little bit low, maybe a tenth low because of some data disruptions that happened during the shutdown. But still, even if you bake that in, it still beat expectations to the good side for mortgage rates and financial markets and everyday people. Obviously,
Yeah.
lower
Yeah. Yeah.
inflation is better for everybody.
No,
Everybody
it's
likes lower inflation.
absolutely, and even rates kind of. We saw the nice yesterday with rates, and today we're seeing that as well. Mortgage rates are liking that information. I mean, liking it meaning they're getting slightly better for consumers, which is good news. We've been really busy at the end of the year. I mean, we're slammed, and we're clearing files, we're taking names, and really kicking butt right now. So a lot of good stuff going on, and
Yep.
in our industry.
Yeah, for sure. I mean, it's the 19th. We're almost to the point where everybody shuts their brain off. But we're already ahead of the amount of applications that came in the door last December. We're basically ahead of where we were for closings already. We still have, a decent amount of productive days left here in the month. So, before everybody
Absolutely.
switches off into holiday mode. So it's definitely an encouraging sign for the industry, I would say, and for the
Good
business.
stuff. Good stuff. So let's jump into our deep dive here. Gift of equity. And, for example, I had a past client of mine, known for 20 plus years, called me a while back and, hey, Bill, I want to sell my house to my daughter and her husband. And I'm ready to kind of cash out, so to speak, and get a smaller place to live. But they don't have much money. They want to do an FHA loan, 3.5% down. And I said, whoa, hold on a second here. Are you familiar with gift of equity? Because he did say, hey, I want to help them out. He wasn't really sure how to structure this quote unquote gift of equity. And I've had, over the years, quite a few times people do this and they're not really sure how to do it. So let's try to explain it in layman's terms in a nutshell, Craig, and then let's go to the numbers.
Yeah, no, for sure. And you kind of you've set it up correctly. I mean, essentially you've got a situation where you've got somebody that has owns a property. They would like to help out another family member. Often it's a child, it could be a grandchild. I mean, it could be, anything, but usually it's a family member. And they want to, help them acquire the property. Yeah, they don't want to give every bit of equity that they have in the property to to the other person. Um, most of the time, I would say. I mean, sometimes they might, but what happens is it's almost, amazing because these happen so infrequently for most loan officers that, a lot of common mistakes can happen. And, and the reality is because there's kinda like a right way to do these and a wrong way to do them.
Right.
And it's really not uncommon that when somebody gets together on these because you've got this, this great situation, you've got these 2 family members, they wanna help each other. One is gonna unload the property, so to speak, get out of the property and gift part of that equity to the other person, the other person's gonna take it over. Um, a lot of times there's no realtor involved, right?
Right.
They may have an agreement between each other. Neither one of them is really in the business of doing this on a regular basis, potentially. And then they go to a lender. So the lender's the only one in the deal with experience sometimes on these deals. And maybe it's been a while since they've seen one. Maybe the deal's already, put on paper in a contract. And so the numbers can really go awry, right?
Yeah. Yeah. That's true. You've had that. And that's why you have to kind of use from a lending perspective, we kind of try to take control right up front. And the good news is that, I mean, what are the pros on it? Well, the pros is that for the people who are going to buy this, they could come out of pocket with nothing really, because in a sense, they're giving away this equity that the seller is going to say, okay, we're going to gift you this equity. That's going to include the closing costs and so forth. If there's sufficient equity in the home, like for my example, my borrower had bought the home in 2008 for I don't know $200,000. The place is worth about 450, so he had a ton of equity. It's the good news is that the borrower is going to be getting a conventional loan with no mortgage insurance because we were like way plenty of equity. So those were all the pluses and but like you said, writing the contract, having an attorney help with that the way it's, where's there a deposit on there, et cetera, and then loading all those closing costs and prepaid items into the formula can be very, very tricky.
So yeah, so let me give you an example. So
Sure.
like so we have a like you have this seller, and the seller has a property that's worth $500,000, right? They've got a loan for 170, and they're saying, "Hey, I want 230 out of this property, but I'll give my son $100,000." So he's really going to be buying it for $400,000, right? And in his mind, that works. And to the son's mind, oh wow, I'm getting a $400,000 property that's worth $500,000. Amazing, right? And sometimes what happens, and I've seen this like almost this exact scenario where they put the contract together, and then the son, he's the one that's got to get the loan. He goes and they write a contract to, they goes and talks to the lender. And he says, "Oh yeah, I'm buying this property for $400,000. I'm getting $100,000 gift of equity." They go, "Oh, okay, put a contract together, $400,000, and then we'll give you a gift letter." So they do that. They come back, they get a contract at a $400,000 purchase price. And they go, "Okay, well, and then what are you putting down?" "Oh, well, I'm getting $100,000 gift of equity. I shouldn't have to
Right.
put anything."
Right.
So they go, "Okay, here's a gift letter." So now they've got this. So the lender's sitting here with this $400,000 contract. They've given this gift letter for $100,000, and now they're setting this deal up. And meanwhile, most of the time, the seller is letting the other, the seller's not involved with the loan typically, so the seller doesn't have a communication with that party, and they just get the gift letter. They go, "Oh yes, that makes sense. I'm giving $100,000 under market value." And what happens is if nobody kind of looks at the big picture and understands, and you don't have, again, a lot of times on these deals, there's no real estate professional in the middle of this except for the lender,
Right.
and maybe the lender's a bank, and maybe they haven't seen one of these before. I mean, it could be any number of different scenarios that have happened, and we've seen the second chances on some of these deals where now they've got a deal set up on the lending side for a $320,000 loan on a $400,000 purchase price, you know, and nobody really realizes till we get to the closing table that, oh, wait a minute. The seller's going, well, oh, no, no, no. I'm not selling the property for $400,000 and giving $100,000. That was
Right.
already baked in.
Right.
And so there's kind of a way to think about these deals that makes things a lot more simple. And so, but it's very, very, very common where they go to closing, and if the person that's handling the loan hasn't, I mean, for me personally, communicated with the seller, make sure they hear from the seller, because sometimes there's miscommunication between the buyer, what that
Sure.
seller wants to walk away from the closing table is a really important number, right?
Absolutely. I mean, they listen, the seller wants to know, what am I going to net? Really at the end of the day, it's kind of like, okay, what am I going to net? And what's the true value of that property?
Right. Yes. So the way I look at it like is this, and I think it's helpful to think about it like this. So you've got this property that wants to change hands. One person wants money out of the deal. The other person doesn't want to come into the deal with any money at all, right? The
Right.
seller wants their a certain number that they want out of the property, and
Right.
this is all assumes that there's enough equity to accommodate everything we're talking about.
Right.
The buyer really would like to get in with nothing if they can, and they can if it's done right.
Providing how much equity is there and how much the seller wants.
How much the seller wants, and then you have, hey, how much does the loan that has to get paid off for that seller? How
Right.
much is that payoff? And then what are the costs to do this transaction? The seller has costs
That's
and the
right.
buyer has costs. And the important kind of frame to look at it in is, okay, what's all the money that needs to come out of this deal, to the different parties and to closing costs? And then if you realize that, okay, if the buyer doesn't want to come in with any money and the seller's getting the money, all the money in the deal comes from us, the lender, right? So you basically just stack up, what do you need? So in my scenario before, the seller wanted $170,000. No, the seller had a payoff of $170,000.
Okay.
He wanted 230, right?
Okay.
So now you're at 400, right? But the seller's got closing costs. Let's call it 7,500. And let's say that the buyer has closing costs, and let's just call it 20 grand, just for simplicity.
Sure.
So you add up all that, now you're at 427.5, right? So you're still, but the house is worth 500,000. So really at the end of the day, and it gets a little bit wonky when you look at it like this, but essentially what really needs to happen is the price needs to get set at the highest value in order to get the maximum equity benefit for that borrower when they close on the loan. So in that case, if it ends up being a 427.5 loan against 500,000, they don't have 20% equity, so they
Yeah.
have some kind of PMI, but
Sure.
probably wouldn't be very much, and that 427.5 accommodates all the closing costs for the buyer and the seller. It accommodates what the seller needs to pay off his mortgage. It accommodates the cash that he wants out of the property, right?
Right.
And that's the most important thing. You don't want to have this whole thing set up, and then you go to the table and the person who's so generously offering to do this for you suddenly is not getting what they told you that they wanted to get out of the deal.
Yeah.
I would say, if you happen to be, and then the lender needs to understand all that, put it together, come up with the gift letter. The gift letter on that deal ends up not being even $100,000. It ends up being like 92.5, because you kind of back out the closing costs that
Closing
that
costs.
that the
Right.
seller needs to pay.
Right.
That it really that the gift letter ends up being the difference between the loan, the price or value, and incorporating the buyer's closing costs, and that gets the buyer in with nothing. So, and sometimes those deals, there's so much equity in it that the buyer gets in, it's 80 LTV or less. They don't have to come out with anything. The seller walks away with the amount that he wants.
Right.
And it can absolutely be done right one time and not have to get redone. But it's really unfortunately common that that's not the case because
Yeah.
they're not set up.
It's complicated. It's complicated on our end, and in my particular scenario I had, there was plenty of equity. Matter of fact, my friend, um, he had a good friend who was a realtor who already run the comparable sales. They kind of had a great idea houses were selling for in the neighborhood, um, and he thought he would sell it to his daughter or husband, and like they do an FHA, and I said, hey, if they do this, they could go this route, but why don't they try going this route to get gift of equity? And, I got with you at the time, and you have the spreadsheet where we plugged in all the numbers and everything. And when they looked at it, like, oh, wow, that makes sense. We get to get this house with a conventional loan, low LTV, no mortgage insurance, etc. but it's complicated on our end, but it's a great benefit for the buyers and sellers if they're in debt. And now you did mention, um, he's selling it to a son or daughter or whatever, but I don't think this could be done for anybody, right? Doesn't have to be a family member you can give the gift equity to, or am I incorrect?
Yeah, yeah. Usually, I mean, what happens is the gift of equity. It is a gift, right?
Right,
And normal lending transactions, that are FHA, VA, conventional transactions, conforming transactions. There are, there's only certain people that are acceptable donors, right?
right,
Just the seller that's not a relative of yours is not an acceptable donor
right,
to give you a gift in a transaction. So it's not something that can be used to, facilitate, the purchase and sale between two parties that don't know each other. You can't really use it for that. But yeah, but if there is a familial relationship, or again, anybody that's allowed to give a gift, and there are times on certain loan programs where, you don't have to be a family member. You can be on FHA. I think an employer can do it. Um, you know, some interesting, more unusual scenarios,
yeah.
then it is, those people could do it. So as long as, but usually it's family member.
But gift equity, let's just stick with family members. I mean, it's
Yes, sir.
yeah, yeah,
Yeah,
yeah.
yeah,
So that's how that works. And then, one of the questions I was asked is that, if we give this gift equity, are there going to be tax implications, from on the seller, and we, whenever it comes in that word tax come up, gift tax, you really have to consult and, you're an accountant or an accountant. And I believe the one time, per year to each family member right now is still like $19,000, but there's more to it than that, and there's a whole the lifetime gift that you're allowed to give away, not get taxed on. But definitely consult your CPA and those types of questions.
yeah. I like to say, I'm not a CPA. I don't play one on TV,
Right.
and I did not sleep at a Holiday Inn Express last night.
That's right. That's right.
So yeah,
That's right. No, absolutely.
check with
So
your accountant.
yeah, yeah. But yeah, definitely consult your tax account. But good stuff and great information. Like we said, it's a gift, the season of giving, right? And it's a really win-win-win for everybody as long as everybody's on the same page and you have a attorney title company that's going to handle it, work with us and do it properly. And we will provide with you the upfront estimates and so forth to show you exactly what all the closing costs are going to be.
Yeah. Yeah, no, it's, I mean, and, of course, it's a great benefit to that buyer, but if you are that family member and you have the opportunity to do that with I mean, with one of your children or grandchildren or something like that, I mean, that's a pretty awesome, way to set somebody up. So definitely, pretty cool thing.
Yeah. Yeah, yeah, absolutely. So, all right, sounds good. Great information. As far as products are concerned, let's kind of segue over to some of the other unique products we have, Craig.
Yep,
I'm closing a loan in the next week, I believe, and it's in a uh, equity line. We do equity lines for unique situations.
there you go.
If you're a client and you have kind of a unique situation, equity lines, if it's an investment property, a second home, or even if you're self-employed and have to use a bank statement loan, believe it or not, we have those products out there. We have those unique products. Also, we've been really busy with condos lately, right, Greg? And we have a investors that are very liberal with financing these condominiums because there could be challenges with going conventional on condominiums, right?
We do, and, it's pretty wild to think that now, that you actually have second mortgage companies and HELOC companies that will let you qualify not only, just on your tax returns, but on, using cash flow out of your bank statements. So that is pretty awesome that that exists. Really 5 years ago, I don't know if that was a thing at all, you know what I mean? 6,
No,
7 years ago, I don't think that was a
no
thing.
way, no way.
I mean, so yeah, pretty good that there's lots of different opportunities for people.
Yep,
Yeah, I mean, condos are, a daily thing that we work with here, and we definitely have a lot of, good flexibility as far as the different investors and what they allow, and we get, all kinds of the condo deals done all the time.
absolutely. Hats off to our team for doing a great job being really on top of everything lately. And it's the end of the year where it's a flurry of activity of people trying to close by the end of the year. And it's really been just kind of crazy lately.
Yeah, and as a teaser, I had a conversation with one of our investors, their national, head of their condo department, who's got really good ties with Fannie and Freddie. And I was told that in January, not prior to January, they were hopeful, but in January at some point, there's an expectation that Fannie Mae will be releasing good news and some enhancements and some flexibilities around condominium insurance. So
Okay.
that was music to my ears, and we even talked about her coming on here and talking through some of those changes when they get released with us, which I think would be a pretty cool thing. So,
That'd be fantastic because,
yeah.
as you well know, a lot of times these condominiums, the challenge is because the condo association is trying to save some money. They take a higher deductible on their master insurance. Fannie Mae doesn't like that. Therefore, it limits a lot of buyers. So if they can have some relief from that, that would open up a whole lot of condos, I believe, to the market, to the first home buyer, especially.
Yeah, yeah, definitely looking forward to that. I mean, that would be the best thing that's happened to condos in, a couple of years, I would say.
Absolutely.
So
Well,
let's see
good
how let's see how
stuff.
it turns out.
Yeah, yeah, yeah. Great stuff. Remember to click like, click subscribe to the South Florida Mortgage Report, and we have our own theme music now. Yes, yeah.
So
So great stuff. Well, listen, Craig, have a great day. Great catching up with you, and we're gonna see you soon. We will see you soon at
the closing table.
closing table. Love this. Great stuff.
Ciao, sir.